Hello friends. Welcome to Anhad channel, where we simplify difficult concepts in accounting, financial management, corporate finance, banking, insurance, and economics. In today's video, we will learn about depreciation. We have divided today's session into 7 topics. These are: Topic number 1, meaning and definition of depreciation. Topic number 2, why is depreciation charged or reasons for calculating depreciation. Topic number 3, how is accounting for depreciation done. Topic number 4, which accounting standard deals with depreciation. Topic number 5, important terms related to depreciation. Topic number 6, factors affecting depreciation. Let's begin. Our topic number 1, meaning and definition of depreciation. Suppose a business purchases a machine for 5 lakhs rupees. Can the machine be used forever? The answer is no. With regular use, every machine gradually wears out. Some assets become outdated because of new technology. Others lose value due to the passage of time. This reduction in the value of a fixed asset is called depreciation. Depreciation is the systematic allocation of the depreciable amount of a tangible fixed asset over its useful life. In simple words, depreciation is the gradual decrease in the value of a fixed asset because of use, passage of time, or technological changes. Our next topic is topic number 2. Why is depreciation charged or reasons for calculating depreciation? Depreciation is charged for 2 major reasons. First, accounting reason. To know the correct value of assets in the balance sheet. Second, taxation reason. To reduce the taxable income of a business by recognizing the loss in value of fixed assets due to their use. When a business purchases a fixed asset, such as machinery, furniture, or a vehicle, the entire cost is not treated as an expense in the year of purchase. Instead, the cost is spread over the asset's useful life through depreciation. Since depreciation is considered a business expense, it is deducted from the business's income before calculating tax. This reduces the taxable profit, which in turn lowers the tax liability. For example, suppose a company earns a profit before depreciation of 10 lakhs rupees. Depreciation for the year is 1,50,000 rupees. Now taxable profit becomes 10 lakhs rupee minus 1,50,000 rupees, which is 8,50,000 rupees. Tax will be calculated on this amount, 8,50,000 rupees. Topic number 3, how is accounting for depreciation done and which accounting standard deals with depreciation? Depreciation is generally charged on tangible fixed assets, such as building, machinery, plant, furniture, vehicles and office equipment. However, depreciation is not charged on land because it normally has an unlimited useful life. In India, depreciation is covered under Accounting Standard 10. For companies following Indian accounting standards, depreciation is governed by Indian AS 16. Our next topic is topic number 4, causes of depreciation. After understanding the meaning of depreciation, let us now discuss the causes of depreciation. An asset loses its value due to several reasons. The major causes are: 1. Wear and tear. The most common cause of depreciation is wear and tear. When a fixed asset is used continuously in business operations, its parts gradually become worn out. Friction, pressure, vibration, and continuous use reduce the efficiency and value of the asset. For example, machines in a factory, delivery vehicles, and office furniture lose their value because they are used regularly. Example: a delivery truck used every day for transporting goods will gradually lose its value due to continuous usage. 2. Passage of time. Some assets lose their value simply because time passes, even if they are not used regularly. This happens because exposure to weather, moisture, rust, sunlight, and natural aging affects the condition of the asset. Example: an office building may develop cracks, faded paint, or weakened structures over time, even if it is rarely used. 3. Obsolescence. Obsolescence occurs when an asset becomes outdated due to technological advancements or changes in market demand. The asset may still be in working condition, but newer and more efficient alternatives make it less valuable. This is very common in industries where technology changes rapidly. Line computers, mobile phones, electronic equipment and manufacturing machines. Example. A company purchases computers today. After a few years, newer computers with better speed and features become available, reducing the value of the old computers. 4. Depletion. Some natural resources lose their value because they are gradually exhausted through extraction or consumption. This reduction is known as depletion. Although depletion is different from depreciation, it follows the same concept of allocating the cost over the useful life of the resource. Examples include coal mines, oil wells, natural gas reserves and stone quarries. 5. Efflux or passage of time or expiry of legal rights. Certain assets have a limited legal or contractual life. Their value decreases as the legal period comes closer to its end. Even if these assets are not heavily used, their value declines because the legal right attached to them expires. Examples include leasehold property, patents, copyrights, licenses and franchises. 6. Accidents or natural causes. Unexpected events may reduce the value of an asset. Although depreciation generally refers to a gradual reduction in value, assets may also lose value because of accidents or natural calamities. These can be fire, flood, earthquake, storm or collision. 7. Inadequate maintenance. Poor maintenance reduces the useful life of an asset. Failure to service machines, replace worn-out parts, or carry out regular repairs causes assets to deteriorate more quickly. Example. A machine that is never lubricated or serviced may wear out much faster than a properly maintained machine. Our next topic is topic number 5, important terms related to depreciation. 1. Useful life. Useful life refers to the estimated period or the estimated number of units for which an asset is expected to be used by a business. It is the duration during which the asset is expected to provide economic benefits and remain useful for business operations. Useful life is not necessarily the physical life of an asset. An asset may still be in working condition after its useful life, but it may no longer be economical or efficient to use due to technological advancements, increased maintenance costs, or changes in business requirements. The useful life of an asset is estimated at the time of purchase and may be revised if new information becomes available. 2. Residual or scrap value. Residual value, also known as scrap value or salvage value, is the estimated amount that a business expects to receive from the sale or disposal of an asset at the end of its useful life, after deducting any estimated disposal costs. Residual value represents the portion of the asset's cost that is not depreciated. Therefore, depreciation is charged only on the depreciable amount, which is calculated by deducting the residual value from the original cost of the asset. Example. Suppose a machine costs 5 lakhs rupees and has a useful life of 5 years. After completion of 5 years, the machine is sold to a junk dealer for 50,000 rupees. This 50,000 rupees is the residual value of the machine. A higher residual value leads to lower annual depreciation, while a lower residual value results in higher annual depreciation. Our next topic is topic number 6, methods for calculating and recording depreciation. There are several methods of calculating depreciation. The choice of method depends on the nature of the asset, its usage pattern, and the accounting policy of the business. The 3 commonly used methods are: 1. Straight line method, SLM. 2. Written down value method, WDV. 3. Sum of the year's digits method, SYD. Let us understand each method in detail. First method is straight line method or SLM. The straight line method is the simplest and most commonly used method of depreciation. Under this method, an equal amount of depreciation is charged every year throughout the useful life of the asset. In other words, the annual depreciation remains constant from year to year. This method assumes that the asset provides equal benefits throughout its useful life. Formula for it is: annual depreciation equals cost of the asset minus residual value divided by the useful life of the asset. Example. Suppose a business purchases a machine for 5 lakhs rupees. Useful life is equal to 5 years. Annual depreciation will be calculated as 5 lakhs rupees divided by 5 or 100,000 rupee per year. For every year, the value of asset becomes zero at the end of its useful life. Look at the screen for depreciation schedule as per this method. This method has advantages like it is very easy to understand, simple to calculate, depreciation remains the same every year, and it is suitable for assets giving uniform benefits. Its major disadvantages are that it does not consider higher repair costs in later years, and it is not suitable where the asset loses value rapidly. Second method is written down value method, WDV. The written down value method, also called the diminishing balance method, charges depreciation at a fixed percentage on the book value of the asset every year. Since the book value decreases each year, depreciation also decreases every year. This method assumes that the asset gives greater benefits in its initial years. Its formula is annual depreciation is equal to opening book value into depreciation rate. Depreciation is charged as per a rate of depreciation. Example: cost of machine is equal to 5 lakhs rupees. Rate of depreciation is equal to 20%. Year 1. Depreciation is equal to 20% of 5 lakhs rupees. Is equal to 1 lakh rupees. Closing value is equal to 4 lakhs rupees. Year 2. Depreciation is equal to 20% of 4 lakhs rupees. Is equal to 80,000 rupees. Closing value is equal to 3,20,000 rupees. Year 3. Depreciation is equal to 20% of 3,20,000 rupees. Is equal to 64,000 rupees. Closing value is equal to 2,56,000 rupees. Look at the screen for depreciation schedule as per this method. Advantages of this method are that it is more realistic for assets that lose value quickly, higher depreciation in the early years, and lower taxable profit during the initial years. Its two major disadvantages are that it is slightly difficult to calculate and the asset value never becomes exactly zero. Third method is sum of the years digits method, SYD. The sum of the years digits method is an accelerated depreciation method. Under this method, higher depreciation is charged during the early years and lower depreciation in the later years. The depreciation amount is calculated using a fraction based on the remaining useful life of the asset. Step 1. Calculate the sum of the years digits. Suppose the useful life is 5 years. Sum of years is equal to 5 plus 4 plus 3 plus 2 plus 1. Is equal to 15. Step 2. Calculate depreciable amount. Cost is equal to 5 lakhs rupees. Residual value is equal to 50,000 rupees. Depreciable amount is equal to 4,50,000 rupees. Step 3. Calculate annual depreciation. Year 1. Remaining life is equal to 5. Depreciation is equal to 5 divided by 15 into 4,50,000 rupees. Is equal to 1,50,000 rupees. Year 2. Remaining life is equal to 4. Depreciation is equal to 4 divided by 15 into 4,50,000 rupees. Is equal to 1,20,000 rupees. Year 3. Remaining life is equal to 3. Depreciation is equal to 3 divided by 15 into 4,50,000 rupees. Is equal to 90,000 rupees. Year 4. Remaining life is equal to 2. Depreciation is equal to 2 divided by 15 into 4,50,000 rupees. Is equal to 60,000 rupees. Year 5. Remaining life is equal to 1. Depreciation is equal to 1 divided by 15 into 4,50,000 rupees. Is equal to 30,000 rupees. Look at the screen for depreciation schedule as per this method. The advantages of this method are that it matches higher depreciation with higher productivity in the initial years, it is more realistic for rapidly depreciating assets and recognizes the declining efficiency of assets. Its major disadvantages are that it is more complex than SLM and WDV, therefore it is less commonly used in practice. Comparison of depreciation methods. Straight line method, SLM charges the same amount of depreciation every year. Written down value method, WDV charges a fixed percentage on the reducing book value, so depreciation decreases every year. Sum of the years digits, SYD uses a fraction based on the remaining useful life, resulting in higher depreciation in the initial years and lower depreciation in the later years. These three methods help businesses allocate the cost of an asset over its useful life according to the pattern in which the asset's economic benefits are consumed. Our next topic is topic number 7: depreciation methods employed by Indian companies. In practice, Indian companies mainly use straight line method (SLM) and written down value method (WDV). These two methods are accepted under the Companies Act, 2013, provided they appropriately reflect the consumption of the asset's economic benefits and comply with AS 10 or Indian AS 16. Friends, with this we come to the end of today's session on depreciation. Thank you very much for watching this video. If you found this video useful, please like, share and subscribe to our channel. On this channel, we regularly upload educational content on economics, finance, banking, insurance, financial crime, GST, income tax, accounting, financial management, and investment management in a simple and easy-to-understand manner. Many of these are in Hindi language also. Don't forget to press the bell icon so that you receive notifications whenever we upload a new video. Thank you for your support. See you in the next video with another interesting and informative topic. Till then, bye and take care.